This week, the best mortgage forbearance plan for the older homeowner who's lost their job.
Click on the banner above to learn more about our sponsor, Fairway Independent Mortgage.
The good news is that the CARES Act does prevent a loan servicer from foreclosing on a federally backed loan for 60 days after March 18th. The bad news is that we're 43 days past that deadline. Homeowners do have another option, however, that is a mortgage forbearance. While the idea of a mortgage payment holiday is highly attractive, many could actually find themselves being unpleasantly surprised because the CARES Act provisions are not clear how lenders and the loan servicer may choose to recoup those delayed payments. To discuss what options a mortgage holder may have, joining us today is my very good friend and also financial advisor, Robert Intellisano. He's from Forest Hills, Queens, New York, and he is otherwise known as the insurance doctor. In fact, he was voted the #1 financial advisor, #1 insurance agent, and the #1 insurance agency in the borough of Queens, New York for the last 2 years. Thanks for joining us, Rob. Appreciate you taking the time today.
My pleasure, Shannon.
In the wake of the coronavirus pandemic, there's been so much discussion in the media about mortgage forbearance. It's hard to go on a financial show and not hear it. How does such an arrangement really work?
Well, forbearance, Shannon, it's the CARES Act. They allow you to pause or reduce your payments for a limited amount of time. They don't allow you to fully erase your payments. So, they give you also several options on what to do. So you have a temporary reprieve, and they will pause your payments. Then you get a menu of choices as to what to do at that point in time.
So what about those loans that are not quote unquote federally backed? So it's not an FHA insured loan. So those have up to 180 days, we're told, and another extension for 180 days. Is that correct?
Yes. So non-federally backed, you have a right to request forbearance for up to 180 days. Then there is another option to request an extension, which would be another 180 days. However, you must contact your loan service provider in order to request your forbearance. The way we're understanding it is there'll be no additional fees, penalties, or interest added. The regular interest will still accrue, and there will be no additional documents required in order to request said forbearance.
So according to the CFPB, or the Consumer Financial Protection Bureau's website, Rob, they say you can seek forbearance, but you could still be required to repay any missed or reduced payments. What kind of pitfalls is somebody who jumped into a forbearance, and I don't blame them for that. There's a lot of financial stress due to the coronavirus or COVID pandemic. But what kind of surprises or time bombs, so to speak, could they be finding themselves with?
The first thing is that you may have to pay back a large lump sum of the back payments that you owe. So you are able to pause or reduce the payments for a limited amount of time, but that doesn't erase what you owe. The missed or reduced payments must be paid at some point in time in the future. So if folks are able to keep up now or catch up, really that's what we will usually advise, is to make those catch-up payments as a first option.
So for the individual, a homeowner, let's say 60 or 62 and older, are they going to have to provide some sort of documentation to the lender or to the loan servicer to qualify for forbearance?
We are the way we understand is they will not need to provide documentation. There's a situation I have actually myself with Wells Fargo, and you can actually call the service provider, the service company, and electronically just press buttons, which would automatically allow you to qualify for the extension, the forbearance, and then you will receive a follow-up letter in the mail outlining what your options are.
So they streamlined the process, which is wise. So let's set forbearance aside just for a moment and talk about some of the other options that could be available to the American homeowner out there today who's just really stressed out. What could those be? What other kind of changes could be made?
Well, aside from delaying once or twice and paying money's lump sum, there are a few other options on how to either pay back or make some changes to your loan. One is called the capitalized or the add-on option, is what I call it. So, for example, if your loan is $300,000 for 30 years and your monthly payments are $2,000 a month for those 3 months, then the bank would add the $6,000 for a new loan balance of $306,000, so your payments would slightly go up. So instead of paying back the $6,000, you're adding it to your $300 which would slightly bump up your payment, but that would be a small increase. There's another option called what I call the extended option, and the same scenario as option 3. However, the bank would extend the time frame. So instead of having a 30-year mortgage, you would have a 30-year and a 3-month mortgage. Now, what could be the best option was called the loan modification option. And that's something that I'm looking at myself. So in that particular situation, the bank would modify or change the loan, possibly with a lower interest rate. So it could work like a refinance without the steep closing costs associated with it.
If you're meeting with, and I know that you have clientele anywhere from, their 20s or 30s all the way on up. If you're meeting with somebody, let's say in their 60s, and they're looking at some of these options, what are some of the things you would caution them about when it comes to refinancing or doing that loan capitalization, restructuring the loan?
Yeah, that's a good question. One of my tips is to calculate your costs. There's always cost involved, and if you're going to decide to refinance at a certain point, which is an option, that will typically run between 1 and 1.5% of the loan. You also want to find out your break-even point, because a lot of times, if you have an older client, they may not want to carry a new 30-year mortgage deep into retirement. So there are situations where it would or would not make sense. You want to find out what your break-even point is. So your break-even point, calculate your costs, and it's important to understand that what could be an option would be a reverse mortgage. I leave that to the professionals, you guys and your specialists. One move that could be made should the client decide to do a reverse mortgage at age 62 or older, now they're going to save a large monthly payment and receive payments